the marketing general market is cyclical. It depends on what is happening in the globe. Even though the long-term trend is up and to the right, there is certainly some cyclicality to that market. But what convincing an individual CFO or chief marketing officer to spend more during downcline is really, really hard to do. But that is something the best marketers actually do, because what is happening when there's a downturn in marketing? Ad rates plummet, right? The demand for ads falls, which causes prices to come down, which means that your marketing dollars are more effective. But convincing somebody to spend more when their business is in decline is really hard to do. The psychology of spending on ads when markets are in decline is the same psychology of buying stocks when markets are in free fall.
You are listening to Power Marketing with Kevin Lee. Kevin and his agency Did It have helped thousands of businesses win through superior marketing, as have his books, articles, speaking engagements, and the E-Marketing Association Power Marketing podcasts. Here's Kevin.
I'm actually super excited to have Brian Feroldi on today, who wears sort of a journalist / content creator hat. So, Brian, you've written books. You've been a contributor to Motley Fool and other publications for years, and you have sort of a long-term mindset business that you run to demystify the stock market. And one of the reasons I wanted you on is because long-term mindset is not something that's unique to an investing strategy, right? It bridges out over other things. But I'd love you to talk more about your book and what the catalyst was, or books, and what the catalyst was for you deciding these books needed to be written.
Sure. Well, thank you for having me, Kevin. It is a pleasure to be here. So I never fancied myself to be a writer. My least favorite class in high school and college was English. And I am a terrible speller. I am terrible at grammar. And my SAT scores on English were average at best. So the idea that I would become an author later in life, if you told me that 20 years ago, I would have laughed in your face. However, when I graduated from college in 2004, I was naturally attracted to everything related to money, personal finance, and investing. And for whatever reason, I just developed a voracious appetite for content that was that could help me to build and grow my wealth. Over time, I discovered that the stock market was the best fit for my investing personality. You don't need a lot of money to get started. You can get started with even like $10 today in investing. So that was a huge plus. The stock market was very liquid, so it was easy to buy and sell. Information was readily available, and it was a semi-regulated industry, and that we have the SEC working for us. But the biggest thing that attracted me was the long-term returns, which just the S&P 500 were about 10% annualized return. However, while I was obsessed with all things related to money and investing in the stock market, what I discovered was that I never came across a book that explained some of the most basic questions that I had about the stock market when I first started learning it. I'd heard for years the stock market goes up 10% per year. And I bought that, but I was like, well, why? Why does it go up 10% per year? Why should we have faith that the stock market will continue to go up 10% per year? I didn't see any book on the market that explained that to me in simple terms, so I decided to write it.
Great. Well, kudos on doing that. And I believe you also run an ongoing sort of content and seminar type or workshop, whatever it is, to continue to educate folks. Because, one of the things about books is, even if they're sort of an evergreen book, right, there's constantly changes. Plus, some people want hands-on help. So what was the catalyst for you deciding, well, the book is great, and I'm so happy I did that. And here you go. You can get it on Amazon or your bookseller of choice. But you also continue to sort of educate in more of a hands-on way.
Yeah, the book is meant to be kind of for Everybody, right? Anybody that has a 401k or wants to retire and wants to save and invest for retirement, my book was designed for you. However, my personal strategy that I have pursued to make money in the markets is through buying and holding individual stocks, and that strategy requires a whole nother level of financial education. You have to know how, you have to learn accounting, you have to learn how to read SEC filings, you have to think through business models, risks, you have to evaluate competitive advantage, you have to think about the valuing businesses, the traps that you can get into. Now, I am the type of person that loves that kind of detail about the stock market, and I am willing to put in that level of work. But in my experience, only about 1% of people that have money in the market are willing to do that level of work. So if you are in that 1% of people that are really interested in the market, yeah, I created a business called Long-Term Mindset, which does continuing education about how to find, buy, and research individual stocks.
So one of the things that, is fascinating about, deciding whether or not to hold individual stocks or allow for sort of a professional to do it, or just allow the market essentially to do it by investing in index funds or the S&P in particular, is that, at least in theory, right, the value of a company at a specific snapshot in time is the predicted future value of the profit cash flows, right? And, it's the uncertainty in that future which sometimes creeps into the market and creates volatility. And some people are really scared of that volatility, and other people are very comfortable with it. So, from an individual stock perspective, how do you guide people about balancing risk versus volatility, or is there like a sweet spot that everybody should be able to find?
Yeah. So again, for me, if the idea of researching an individual stock or the idea of individual stock volatility scares you, no problem. Dollar cost average into index funds, period, full stop, end of story. You don't have to know anything about accounting or individual stock analysis. All you need to know is the basics of what the stock market is, how it works, and why the stock market goes up over time. If you can get that base level of education, dollar cost averaging plus index funds are for you. But yes, volatility does scare a lot of people, and that is because they don't understand what volatility is, what causes it, and I would argue the reason why they should believe that stock prices should increase over time. From before I knew anything about the stock market, I at least had a general idea of why the stock market declined. It's not hard to understand why the stock market declines. In the last 20 years, 25 years, we've seen three massive bear markets. Bear market number one, the 2000 dot-com bomb, right? There was a recession in the United States. All these tech stocks were way overvalued. They came crashing down. And then we had 9/11. Bad stuff happening. It makes sense why the stock market crashed. 2008. The biggest crash since 1929. We had a housing crisis. We had a financial crisis. We saw unemployment skyrocket. We saw the government deficit balloon. Horrible stuff happening everywhere. It makes sense why the market declined. And then finally, 2020, COVID. Right, the world got shut down from a global pandemic. It makes sense why the market declined. So I think declines, downside volatility, is at least intuitively understandable. Bad stuff happening, the market goes down. What is not intuitive and not understandable is why the market recovers, why the market went up in the first place. And I think if you understand why the market recovers, why individual stocks can recover, they don't always, but they can recover. If you understand the principles that cause prices to go up in the first place, it will give you much more confidence to continue investing even when prices are declining.
So I'd love to flip into sort of a marketing mindset. Obviously, you sometimes wear a marketer hat for yourself, right? Marketing your book, marketing your ongoing educational courses and seminars. And what I find is that it's equal to volatility in the market, where all of a sudden people get pessimistic about the future of a stock price or about a company's prospects in the future, right? Therefore impacting stock prices. And sometimes the CFO gets pessimistic about investing in marketing for that company, and so pulls back often too much, right? Because if you stop marketing, then you're likelihood of having future cash flows and future growth and future profitability goes down. So I'd love to tie those things together if you can in an interesting way about, how the investing mindset and long-term investing mindset really bridges outside of purely individual stocks or indices within funds and bridges off of the business and marketing at large.
Yeah, you bring up an excellent point, which is that marketing and spending on marketing is a capital allocation decision. And since the returns that you get on marketing are not always immediate and they're not always measurable, it is understandable why, when tough economic times hit, so many companies choose to pull back on that spending, for marketing. And the marketing general market is cyclical. It depends on what is happening in the globe. Even though the long-term trend is up and to the right, there is certainly some cyclicality to that market. But what convincing an individual CFO or chief marketing officer to spend more during downcline is really, really hard to do. But that is something the best marketers actually do, because what is happening when there's a downturn in marketing? Ad rates plummet, right? The demand for ads falls, which causes prices to come down, which means that your marketing dollars are more effective. But convincing somebody to spend more when their business is in decline is really hard to do. The psychology of spending on ads when markets are in decline is the same psychology of buying stocks when markets are in free fall. Another thing that mimics this perfectly is stock buybacks. That's when a company repurchases stock from its investors. If you look historically, management teams have a horrible track record at buying back stock. Why? Because they're humans. They buy back their stock when everything looks good and prices are high and they have excess capital. And they stop buying back stock when their prices are down and the markets are generally gloomy. That is quite literally buying high and selling low, or at least not buying when low. It's the exact opposite thing to do, but you're fighting against human nature. So you might be able to convince individual marketing officers to spend more when the markets are down, but as a whole group and a whole category, that is changing psychology en masse, and good luck with that.
You know what my favorite part is about that tie-in, where it really hit home for me. I'm going to use it next time I'm chatting with a CMO or a CMO CFO pair who's trying to do marketing austerity, right? Is applying the dollar cost average math to marketing.
Mm-hmm.
Not only do you get the ads cheaper because other folks, particularly your competitors, are pulling out, right? But your message resonates more because it's not as loud, right, in the market. Then the competitors have all said, I'm scared. I don't want to be out there with my marketing message. And so not only you get more impact for the dollars you spend, not only because it was cheaper, but because your share of visibility, right, goes up. So the dollar cost averaging mindset, as it applied to marketing expenditures, is actually a really good one, right? Because even if you want to apply sort of the no-brainer way of doing it, just the fact that media is cheaper and you get more market message resonance, that's a win right there.
Yep,
So
sure is. So many things about investing and capital allocation relate to other categories, including marketing.
Right, exactly. So how do you decide what to cover? Do you have on your ongoing training, do you have sort of an editorial calendar that's set months in advance, or and a curriculum that you use, or do you base it on sort of what happened in the market within the previous weeks and months to every session?
Both. The answer there is for our public, freely consumable content that we produce on YouTube and Twitter and LinkedIn, etc. That resonates most and has highest impact when it is immediately relatable to what's in the news. So when we see companies report earnings that come out, especially when companies decline in the wake of earnings, that's when interest in that topic and that company is really high. And we produce content, free content, that is out there related to that topic. But when it comes to content that we produce behind our in our community, so for our premium subscribers, that is scheduled out months in advance. And everything we teach in there is always evergreen in nature, has no expiration date, and they're the principles that apply really in all time. So the answer is a hybrid between the two. But if you want to make the most of your public facing money and your public and the content that you produce for the public, tying it into what's happening right now or what's on people's mind is an easy way, or at least is one way to increase the odds that content will be seen by more people.
Great. I'd love to hear how you think about sort of individual company risk versus sort of macroeconomic risk and geopolitical risk, right? Is obviously you can look at a company's stability, their growth. You can look at their financials. Financials are obviously rear view mirror data points, right? And you're trying to extrapolate out from that. But the future is what the stock prices are actually based on, or the consensus, let's say, within the investing community of what the future looks like. And so, when a stock price declines on an individual stock, deciding whether that's a buying opportunity or due to some sort of emotional reaction of the market that's not really reflected in the future of the company, or in fact, is a change in the risk profile for that organization or the future cash flows of that organization. It takes a fair amount of time and energy, right, to invest, to tease out those differences. And a lot of folks have full-time jobs, right? So they don't have the luxury of time to at least cover a large basket of stocks, but they might be able to narrow down to sort of a small basket of stocks and do deep dives on those. So how do you recommend folks sort of decide, how many stocks should they focus on given the amount of time investment that they have, both from a de-risking of their portfolio perspective, but also from the practical elements of, hey, I'm not a professional trader. Maybe some of your clients are, but professional traders, even they tend to focus on a narrow swath of stocks that they cover.
Yeah, so there's a key distinction I want to make sure we double click on because it's important. The market in general, the stock market as a whole, aka index funds, when that as a category declines, the odds of that being a buy opportunity are extremely high. Extremely high, because you're buying all companies. You're making an investment in the entire market. It is a different story when an individual company declines. When an individual company declines, it could be a great buying opportunity for that business, or it could be a great selling opportunity for that great business. You have to get into the details of why the company is declining. Sometimes declines make companies less risky. Other times, a company can decline 50% and be more risky. It totally depends on the situation. With an individual company, you asked the question, how can you tell which is which? Well, the thing that you have to ask yourself is the thesis for that company, the core reason that company was a buy in the first place, is that thesis still intact, or is that thesis permanently impaired? Let me give you a quick example. Rewind the clock to 2002. Blockbuster was the king of movie rentals, right? And the thesis for Blockbuster was more people love movies. Blockbuster has the greatest network across the United States. They rent these movies. Out. They make these huge profits on late fees. They're buying back stock. Management is deploying capital at high rates of return. Well, when Blockbuster stock was declining because the market saw Netflix coming along, was Blockbuster a buy? No, it was way riskier because the market saw Blockbuster's business being disrupted. And every time Blockbuster declined, it was riskier because that meant it was getting closer to being fully disrupted. So you have to have that level of insight. Now, compare that in contrast with the recent decline we saw in Facebook stock. 2 years ago, the narrative on Wall Street was TikTok is coming and is going to ruin Facebook's business. And Mark Zuckerberg has been deploying way too much capital in Reality Labs, and he's wasting all of this shareholder capital. And Facebook stock went from like $300 a share to $80 a share. That's like a 70% decline. But when Facebook was reporting actual results, revenue was still growing. Profits were still growing. Margins were declining, but the company had the moat, the core business of Facebook was actually still extremely strong. So that was the case where the sentiment was not matching up with the reality of the business. So when Facebook stock was declining, it turned out to be a fabulous buying opportunity. So if you're going to invest in individual stocks, you need to be able to tell the difference between a stock declining and getting riskier and a stock declining and getting more attractive.
One interesting tie-in again to marketing and marketing investing is when you use the word sentiment, right? Sentiment is really the sum total of the emotional side, right? Is driven off of data, or at least people like to believe that it's driven off of data. But when it's temporary, it really is sort of emotional. And sometimes the emotion is sort of the lemmings effect of everyone sort of suddenly having groupthink and deciding Facebook is a bad stock, because obviously in any marketplace, right, supply and demand, a whole bunch of sell orders come in, right? Unless somebody's willing to buy, price is going to drop to the new clearing price, right? And in marketing, right, the sentiment of the management team, right, often determines their willingness to invest, right? So if there's a change in sentiment in the C-suite is going to change their behavior, sometimes rationally and sometimes irrationally. So when you look for this mismatch, there's a lot of folks that are, famous stock pickers. I mean, the Berkshire Hathaway, right? Famous in the way that they think about it. Ray Dalio, also a stock picker with a great history. So, do you think about any sort of your heroes in the ecosystem that you resonate with, where you think their methodology of looking for those opportunities where the sentiment doesn't match reality?
Yep, there's lots of ways that you can invest successfully. There is the value investor way that looks specifically for stocks that have declined, where the sentiment doesn't match up with the business reality, or there are dark clouds that you can see through, meaning there's something temporarily going wrong, but that problem is fixable. That is one way to invest, and that is the way that Warren Buffett has invested for decades, and he's done so successfully. There's a completely different way of investing, which is you are making bets on growth companies, and the bet that you're making is that new technology will disrupt the market and take over the world, and that has a high failure rate. However, you can occasionally buy the next Amazon, the next Tesla, the next Netflix, and if you can do so, the gains that you can get by picking the right disruptor can dwarf all of your other losses that you have combined. And if you're going to be investing like a venture capitalist looking for the next winner, you actually don't want to buy stocks when they're down. You want to buy stocks on the way up, because those stocks get less risky as the price increases. So one critical thing for all investors to do is to ask themselves what type of investor they are. Are they a growth investor? If so, they should de-emphasize valuation and de-emphasize buying stocks at a discount. Or are they a value investor? In which case they should emphasize buying stocks at a discount and wait until the stock is trading below their estimated intrinsic value. There's no right or wrong way to do it. You can make money with any style that you want, but it's really important that you define your style before you put capital to work.
Yeah, the reason I'm laughing is that that's a perfect analogy to the way the venture capital versus PE markets work, right? Is they also have a mindset when they go in and deploy their capital. In the case of PE, often it's leveraged capital. And sometimes that works out great, and sometimes it doesn't work out so great. But they're also sort of looking for, deciding how does this company fit into the narrative thematically, right? And if they see something that somebody else doesn't, right, then they feel like, okay, I'm willing to deploy capital. And in the case of markets, a lot of folks argue, well, it's very difficult for me to see something that other people are missing, right? I mean, there's a bunch of professional investors out there, and the idea is that the market is perfect, right? And that most information is supposed to be public. Do you find that AI and certain research methodologies can in fact give the investor an edge in that, and sort of almost like outthinking or outsmarting the rest of the investor community.
So AI is a rapidly emerging tool, and there are tools that are coming out that will make researching stocks, vetting stocks easier by having the AI do some of the heavy lifting for you. For example, you can ask the AI to screen stocks for certain criteria, or to identify stocks that are down a specific amount from their recent high, or whatever. But I want to push back about something that you just said, which is that the market is perfectly efficient. This is something that is taught in colleges, that the market price, that the market knows all, and that the market can perfectly discount all of the risks and available information back into a company's stock price. My modification is that the market is largely efficient, but the market is still run by human emotions and human decision makings. Even when you're using AI to invest, there are still humans making the decisions that go into the outputs of that AI. And real quick example, Microsoft Corporation, a $3 trillion company. Microsoft has been around for decades. Its business, its products are extremely well known. The company is extremely diversified. It's got dozens of analysts who just track Microsoft full time. That's all they do. And yet Microsoft over the last year has traded at a 52-week low of $306 and a 52-week high of $430. That is a $800 billion difference in the company's market cap. $800 billion. So you're telling me the market is perfectly efficient, so much so that Microsoft, big, stable, predictable Microsoft, its value has shifted by $800 billion? That does not sound all that efficient to me. In fact, that's a 30% difference in the top to the bottom. So I think that the market is largely right that Microsoft is worth somewhere around $3 trillion. But even on extremely predictable, well-covered companies like Microsoft, there are still plenty of inefficiencies in the market.
Well, that happens to be the one stock that I trade both own long term, but also trade covered calls on, because usually if you look at the sentiment, you can, if you sort of time your covered calls sells, right, you can find overly optimistic pockets. Now that doesn't necessarily jive with the long term investing mindset, but it's just interesting you mentioned Microsoft, which is I've watched its cyclicality over years. And of course, it's one of the most stable cash flow and stable businesses out there when it comes to overall, risk and reward dynamics. Do you recommend that folks use, even in a long-term mindset, use any of the other vehicles like options in certain instances, or are you more of sort of a buy and hold investor?
I have nothing wrong. I have nothing against using options. I've used them in the past. There are ways that you can use options to actually reduce your risk. You mentioned selling covered calls. That is one option that you can actually do to reduce your risk in the stock market. And if you're interested in learning about options, there are ways to do them the right way. For me, the hassle to reward ratio is not high enough for me to play around with that market. But I don't boo-hoo anybody that chooses to do so.
Great. Well, any final tips for folks who, they may be marketers because it's the Marketing Association podcast, but they may be aspiring investors and looking to maybe take more control over their portfolio. So other than buying your book and tuning into your content, any other sort of tips you would provide?
Well, we're all investors, whether people realize it or not. We're always investing our time mostly and our capital. And if you live in the United States, or you have a 401k, or if you have an ESPP, or if you have stock options, you're an investor, whether you like to or not. And to me, the first step to investing is always the same: educate yourself. Educate yourself. It is never ever been easier or cheaper or more convenient to educate yourself. So go to whatever platform you naturally are spending your time on. All right. Do you like podcasts? Search podcasts for episodes about investing. Do you like reading blogs? There are plenty of blogs out there. Are you on Instagram? Are you on LinkedIn? Are you on YouTube? There is tons of free, high quality education out there that you can use to educate yourself about the basics of the stock market. I wrote a book that is a great resource. If you're a reader, I would suggest going for that. But step one, always the same. Start by educating yourself about the basics and then go from there.
Great. Thanks so much, Brian. I appreciate you joining me on my podcast.
Thanks for having me, Kevin.
Kevin Lee's Power Marketing is available on all your favorite podcast networks. Kevin loves helping businesses excel at marketing. Having marketing challenges? Just like Santa in The Miracle on 34th Street, if Kevin can't help you, he'll know someone who can. Find him on LinkedIn, subscribe, or follow.